What's up, guys? I'm Nobody Special, and I have my buddy Travis from Real Estate Mindset is back with us today, and we are going to talk about the housing market. Travis, how you doing today, brother?
Sir, happy Monday. I'm doing well. I'm back after about I can't even talk. It's been so long. I'm back from about 3 weeks of driving solo around the nation. Just got back from Miami. Really excited to be here, brother. Really missed our conversations.
Well, thank you for taking the time to talk to us today, and it's good to have you back. Now, Travis, I was watching the Fed's press conference. I was live streaming it last Wednesday. And after weeks and months of telling us it's premature to even talk about any rate cuts, Powell came out, totally contradicted himself, and they did nothing but talk about rate cuts on last Wednesday. Powell said 3 rate cuts, or the dot plot says 3 rate cuts in 2024. The market hears 6. And now asset prices are mooning. Stocks have just gone up in a straight line ever since then. Bonds have gone up in a straight line. Gold is up, silver is up, Bitcoin is up, everything is up. I'm assuming houses probably heading in that direction too. And I was left just not knowing what to tell that kid, that millennial, maybe that older Gen Zer who trying to save up money to buy a house. They've been waiting for years. They've been doing everything right. They haven't been FOMOing in or chasing a market. They've been building up their down payment. But it just seems like inflation, they're swimming against the tide. And now Powell's cutting rates. And I don't know what to tell that person right now. So I figured I would go directly to the source, the real estate guy. Tell me about that Powell pivot. What does it mean for the housing market? What does it mean for that kid who's been saving up for a house and he's been priced out?
Yeah. Well, the first thing I'd like to say is you're about to learn a lesson of patience as a virtue. I had to wait 9 years after I had my foreclosure, bankruptcy, and repo. So be patient. I would say, stay encouraged, continue to increase your purchasing power. And we're in an era right now where it's a tale of two tales, whether it's existing or new homes or whether it's Miami or Austin. So it's really, really important to use the data. You don't want to get stuck on the sideline. You don't want to be just twiddling your thumbs. But if you've done, paid off your consumer debt, you have, money saved, 6 months of money saved, have the right expectations, and you find a deal, then maybe take it. But the important thing here, Jack, and this is going into 2024, 2025 housing market crash, or any if it doesn't crash, you got to use the data. You have no idea what type of deal you're getting unless you're reviewing comparable things and not using your emotion to buy. So I would say, congratulations, because when I was a young adult, I couldn't buy T-bills and get 5% back on my money. So, and also understand to those kids on the sideline, hey, you get paid to wait right now. And I mean by, that if you have a down payment saved, what I'm doing with my down payment, I'm buying 1 month treasuries. I'm yielding back 5.3% annualized. I've also rearranged my credit cards. I don't believe in credit card debt. You should pay the bill off. You should pay the balance off. But I use my credit cards to do everyday spending like gas or food because I get cash back. So those are good things. As far as the housing market, that is a very, the specificity that comes with talking about the housing market is especially important, Jack. And I think what has potentially happened right now is the sentiment is changing. When you hear, rates are going to go down, rates are going down, they're talking about a quarter basis point, at best, 3/4 basis point decreases, which is very minute. I think if we have interest rates go down right now and it's only little tiny baby interest rate drops like that, I think that's going to be bad for consumers. I think in certain markets that are tight with just existing homes, I think that could be a potential problem for demand. I think what we need is massive rate cuts. If we have massive rate cuts, generally it's because, or it should be because of something going wrong in the economy. I believe what that's going to be is commercial real estate. I think when the commercial real estate meltdown happens, it's going to kick up unemployment. We'll have real rate cuts, not these little baby rate cuts that they're just, polarizing, but substantial rate cuts because of economic uncertainty. I think some metro areas are going to need that to have prices. I'm not talking affordability. I'm talking prices go down. But in other metro areas, like in Dallas, that are massively heavy in new construction, massive amounts of inventory potentially coming to the market from short-term rental bans. I think in areas like that, I think it's prime time. I think areas like that are going to crash. In fact, they're already crashing, depending on what metro and area you're looking at. Now, having said all that, and I have some data to show you, one other thing. Everyone should know by this point, real estate is local. Okay, it's location, location, location. When we're talking here, it's really important to understand that Jack and I are talking about both national data and a little bit of localized data. But if you want to be real and you want to really understand what you should be watching is basically it's the subdivision. Every subdivision, even in distressed markets like Austin, Phoenix, Las Vegas that I've been to, some subdivisions vary significantly with the amount of hypersupply, with the amount of turmoil that's in the subdivision. So I just wanted to remind everyone, Jack, we're talking broad terms a lot of times. We'll go to state, we'll talk new construction, we'll talk existing. But when all that smoke settles, man, people need to be really reviewing the subdivision. And then from the subdivision, you look at the city, right? You look at the area, the county, even the state. But you got to look at subdivision, brother. And honestly, if people could be doing that, becoming experts on subdivision data, pat yourself on the back. You're doing the right thing. So where should we start?
Well, let's look at some of that data you said. Show us, where are these islands of green within the sea of red, if you will.
Okay, so the first thing I want to do, if I can, is let's talk about Dallas. Now, before I talk about Dallas, Jack, again, we're talking about Dallas first because it's my backyard. I live in Houston. Dallas is in my backyards. And I want to paint the picture on what's going to happen once we have inventory. One of the main issues right now with existing homes, it was basically the issues with existing home inventory. We have inventory for new construction. We don't have that yet with existing homes. But the thing that I want to remind people is there's probably anywhere from about 1.25 million to 2 million people, home sellers on the sideline, that would sell their house if they could afford to. I'm basing that off of the lack of transactions this year. So when we look at the reduced transactions this year, people selling their houses, again, 1 million to 2 million people on the sideline that would sell if rates go down substantially. But again, the thing is, Jack, they got to go down substantially. A quarter basis point, 50 basis point, that's nothing. So what I wanted to start, if I can, I want to start by talking about new construction because I believe that new construction is leading in both price decline for obviously new homes, but also is leading to price decline in existing homes because we're seeing it start to spread. So I want to encourage your viewers to go to newhomesource.com. All right, newhomesource.com is supposed to have all of the listings for new homes, but I'll tell you right now, this isn't everything. I've been on the field, boots on the ground, eyes in the sky. I got my drone license, by the way, and my drone is registered FAA inspector. Feel free to inspect me. But brother, holy smokes. Okay, so first of all, I put in Dallas area up here. Okay, so Dallas area, and we're going to put this in perspective, has 10,378 homes listed. Okay, various stages of construction, but it's all new homes. Okay, you got that? 10,000,
right?
No, that doesn't matter if they're under construction or readily available. It's everything.
Okay.
So a lot of this is active, move-in ready right now. And I'm also saying this is underreported. There's probably closer to maybe 20,000 units.
So they're all new homes in various stages of completion, some being complete move-in ready.
That's correct.
Okay.
This is an awesome site right here if you want to just investigate a certain pocket or a certain metro area, because this is on the left here. It's going to list like all the price cuts, where the hot deals are. This is a lot of data, Jack. Like this one here, 15,000, 11,000 off, 18,000 off. This one's $47,000 price cut. I mean, do you see why I talk about this all the time in my back? Look at this, Jack. $250,000.
Are these legit? Are these legit price cuts, Travis, or are they just listing them for $250 so they can cut them $50,000 to $200? Or
both?
Okay.
That is why I say so often it depends on the subdivision. I can pull up 2 subdivisions in my area of Houston, and one subdivision is getting destroyed, 2021 prices, 4.5% interest rates. But another subdivision is showing a $200,000 price cut, Jack, but it's still above market value. So depending on the subdivision and the builder, like this one that you see on the screen shows $250,000. Okay, see that? $250,000 off. But remember what I just said. We need to review data in the subdivision. So the only way for us to know if that $252,000 price drop is accurate is by reviewing comparable data or homes that have sold already. And I like to go back 3 years because obviously we've been dealing with this crap for 3 years. So I want to know what it was before we were dealing with all this crap. Okay.
Before
but you see that right here.
Hit. Yes.
Yes. You see how I didn't say that? I wanted to, I didn't say that. But I mean, you see this around here. So again, in order to understand what is a price cut and what is not a price cut, you have to go so localized, you go subdivision. But this is an indication in the Dallas area, 10,000 homes that are just listed, probably more like 20,000, but this is listing 10,000. So what I want to do, let's see how many existing homes are listed. Okay. According to Zillow, in the Dallas area, okay, so this is in the Dallas, Texas area, existing homes for sale. And honestly, there's possibly some new homes in here, mixed in here. 3,800, Jack.
Wow. So you're talking 10,000, almost 10,400
that are listed.
Various stages of completion on newhomesource.com. Was that the website?
Yeah, well, it's right here. I'll show you. Newhomesource.com.
Yeah.
Yes.
10,400 or so showing there.
That's underreported.
3,800 on Zillow.
That's right.
Where did all that inventory go?
It's still there. The cat's out of the bag in places like this. That's what I'm trying to say. For areas that are blessed, like I'm in areas that are showing significant, supply of new homes. In these areas, they're spreading inward to these existing houses. Again, let's put the overlay. Look at this. See how Dallas doesn't have that many new homes? See that?
Yeah. It's
just surrounded like an army of ants that are attacking. But when we go here, all of the pressure and decline are coming from areas like this. All right. And again, you have to do the data analyzing. But again, going back to this, so we have 3,800 existing homes listed. But remember, Jack, not only do we have new construction, and I'm taking Dallas because it's an extreme example, okay? So I know not every metro area, but they banned STRs. I know it was extended to, I think, June or July. I don't care. They did the same thing in New York. It's still dead. And look at when we go to AirDNA. When we go to AirDNA, okay, and this is downtown Dallas. This is in the good spots, right? This is not new construction areas. We have 9,900 listings in Dallas, okay? But remember, we got to figure out what is the homes, right? Total home, not just the room. So we go 9,900, and then 89% of entire homes. So we go 0.89, which gives us 8,800 potential listings that will have to hit the market. So let's just round it down and say there are 800 that will be able to stay. That's 8,000 more units, whether it hits the rental market or the existing home market. That's a triple up. That's a double to triple up with the just existing home loans. Okay. Now, the reason I'm telling you all of this is because these are the things in the background, right? This is not the economic turmoil. This is not the collapse. These are things that are going to magnify when the market actually crashes. So the question is like, how does it happen to places like Anaheim? How do we get prices go down in Anaheim and Santa Ana and things like that? And I think that when we look at the federal funds rate, okay, and what we need is, so what I think is going to happen if they start lowering rates a quarter basis point, 50 basis points, absent an economic crisis, I think it's going to mess with people's head. I don't think it's going to be bringing too many people off the sideline to sell. I think there's going to be more buying demand than selling demand. I think it's going to be initially bad, but I don't think that's going to prevent a housing market crash. I think it gets the bubble bigger and even worse because these things are playing out. But when we look at the federal funds rate, when they start cutting, we head into a recession. You can see that going back forever, essentially. Hold on 1 minute. And so what happens is when they cut rates, again, historically, when we've been inverted and they start cutting rates, it leads to a recession. So I think, Jack, that once the real rate cuts hit, okay, so I'm not talking about these election rate cuts. I'm talking about we got to cut rates because something bad is happening. And I think that bad thing is commercial real estate. I really do. I think commercial real estate is going to create a domino effect in the banking sector. They're going to tighten lending and it's going to domino effect into unemployment. It's going to hit consumers. That's what I believe is going to happen. That's what all of the data is suggesting that an event is going to happen. I just think that, that's going to come from commercial real estate. But when we look at the market here, Jack, okay, this is See Me Fed Watch. You see this all the time. The market is saying, no way, no more rate cuts, dude. They're saying you're a psycho, Travis. You're just a bear. Okay. Well, you were wrong about everything, right? And honestly, you want to know what I was really wrong about is the power of the reverse repo market, man. I think that reverse repo market that's being drained, by the way, is the real smoke screen, is really propping things up. And that's why the data is so confusing as well. But I mean, according to the market, at best, we're going to stay elevated where we're at right now to January. That's it. After January, we go to March. The market's like, maybe you'll keep the rates where they're at, 31% chance, but they're like 63. And by the way, they are always wrong, but 63% likelihood that there'll be a quarter rate cut in March. Okay.
Wow.
And then when we look at May's like, quarter rate cut, 37% chance, 50 basis points. So that's more likely the market's saying that we're going to have a second rate cut of a quarter basis point in May. So again, just looking at this because we're on another tier here. So we got quarter basis point cut in March, quarter basis cut in May, which is nothing. That's literally nothing. We need 175. There's nowhere in this that is planning for the economic uncertainty. This is data, Jack, and this is why the market's rallying. This is all soft landing data. So we go to June, same thing with June. Look at 50 basis points, 37, 75 basis points, 50% chance. And then the same thing in July. They're basically saying, and it gets a little bit dicey in July, kind of it tapers off a little bit, but they're pricing in quarter basis point hit. June, March, May, June, July, pretty much in July. You can see it's 43%, but I think the market's got it, totally, absolutely, ridiculously wrong because again, we don't have significant rate cuts unless something bad happens. And then when we start looking at fundamentals like PE ratio, because that's when fundamentals matter, right? They don't matter when everything's going well and just continue to buy. They start to matter when things fall apart. They're like, oh yeah, silly people, you should have never bought that. The fundamentals didn't work.
Be
right?
A lot of people out there better hope we never get back to the point where valuations matter. Let me just put it that way, because there's some pretty absurd valuations out there right now.
If you want to upset some bulls, Jack, use the word fundamentals. Yeah. The bullish narrative is now, oh my God, Federal Reserve, save me. That's it. They're gambling that the Federal Reserve is going to save them. And honestly, I think it's going to primarily come from commercial real estate. But just looking at fundamentals, okay? Now, interest rates affect payment. I think price is more important than payment, but let's look at payment. Okay, so looking at this chart, this is the national payment to income ratio. I've gone over this a few times. This is sitting at 40.5% of people's gross income going towards paying principal and interest. As a homeowner, Jack, you should know that owning a home is way more than principal and interest. It's also property taxes, which in my state could be $12,000, and homeowners insurance, as well as HOA fees. So none of that is included in there, nor is this counting net income. Okay.
Wow.
Now,
so just principal and interest is, what are we looking at here? 46%. Is that what that's saying?
No, 40.5%.
40.5%, just principal and interest payment to income. That's amazing. I mean, historically, anything more than 30, 35, you're in trouble, right? And that's your total payment, not just principal and interest. That's everything.
As a loan officer, that's not how we calculate qualifying income and debt to income ratio. No one calculates national payment to income ratio this way. Again, as a loan officer of 22 years, you've got to count taxes, insurance, because they're included in the payment, and HOA. And for VA loans, it's more than that. You got to take net income for VA loans doing residual income calculations. So this is not how purchasing power is calculated, first of all. But it's what we have to use as data, okay? And honestly, what I like to point out, and this is last bullet point right here, it says to get back to normal, okay, long-run affordability levels would require a combination of rates going down 4.4%. They've gone down 1%. So they got 1%. They needed to go another 3.4% down, and or 62% rise in median household income. I'll raise my hand if we can all get, without hurting and causing more inflation, Jack. Just give me that 62% more income. I'll shut my mouth, carry on my day, and I'll go buy a house right now. But I need that 62%.
If you're offering, but
I mean, yeah, well, I'll have to still use the fundamentals. Those still are important, but I'm just saying 62% is a lot of money more to make. Or, and here's the real big thing, 38% decline in median home price. And I think what's important to understand about that 38% decline is we don't need 38% decline to go back to pre-COVID levels. That's just showing us and demonstrating how unaffordable things really are. So I'm not talking about
COVID levels, correct me if I'm wrong, were already pushing bubble valuations in and of themselves, weren't they?
From a PE standpoint, yes, but from a payment to income standpoint, no, because the interest rates, right before COVID, remember, they were like 3% and 4%. Interest rates were 3% and 4% in 2019. They were actually starting to go up, I believe, if I'm not mistaken. So we're used to 3% and 4%. And even then, the PE ratio, and I'll show you that right now. Let me show you the PE ratio. Here's the PE ratio. Now, I think this is when we look at this, it's a little bit easier to see the bubble. This is the median home price to median household income ratio. Again, very important fundamentals about the housing market. Interest rates going down potentially could put pressure on this going up. So it's important to understand that the interest rates going up or down doesn't necessarily affect the PE ratio, although it does adversely. Obviously, because the rates were so low, PE ratio skyrocketed. Okay, but I just wanted to point out the PE ratio is now higher than it was during the GFC, Great Financial Crisis, and that was also made in half of the time. So we have unaffordability of the 1980s, and we have an asset bubble that was bigger than the GFC, made in half of the time. That's just not a good combo.
So we've got the worst qualities of the 80s housing market and the pre-bubble housing market combined right now.
And then ask, how did the prices go up? Was it because it was such a great deal to buy a house? Or was it because of fear of missing out, appraisal gaps, waiving the contingency, and overall America obsessing about being a homeowner? The foundation, Jack. And then you add on top of that low interest rates, the foundation is...
And the STR bubble on top of that, absolutely.
One more thing I want to put at you because you've been following this, okay? So look at the PE ratio. Okay, during the GFC, again, about 6, I think it got to like 6 point something, 6.4, 6.8, 6.9, okay? Understand how that happened. This time around, it happened because of emotion. Last time it happened because 40-year mortgages, negatively amortized loans, interest-only loans, and even with the ability for all of America to commit fraud and buy a house, the PE ratio was still lower. Think about it, what I'm saying. It was still lower than what it is now. Even with all those toxic assets, that should tell us how much out of whack home values got, from 2020 on. The bubble is massive, and it was done with mostly conventional, qualified mortgages.
Wow.
And so when we look at this map right here, Jack, this is going to, to the people on the sideline that are, oh my gosh, the media, we're already having home values soften. This is seasonally adjusted. You can see, again, the areas in Texas are leading price decline. You can also see on the West Coast, also leading Seattle, Oregon area. You have, other areas, Nevada, Phoenix, Vegas areas are going down. Not so much the East Coast. So the East Coast is remaining resilient so far, as is Florida. But again, what I see happening when I see this, Jack, I see the bubble getting bigger. So I think, again, interest rates going down prior to substantial risk in the market and unemployment. I think in some areas like the East Coast right here, it's going to hurt. Possibly prices are going to go up until it all falls apart. In some areas like the West Coast, like you got San Diego, you got Anaheim right here, that's going to hurt. But in other areas like Texas, that we already have hypersupply, we already have 4.5% interest rates, I don't think that's going to do anything at all, quite frankly. I think it's going to remain the same. It's going to go sideways. Another thing I want to point out, if I may, as far as inventory, COVID-related forbearance protections ended about 2 weeks ago. So the end of November, people are no longer protected from COVID-19 related forbearances. I know it's shocking to think that anyone was still protected from foreclosure, but roughly 360,000 households have been protected by that COVID forbearance that ended again in November. So going into 2024, we will have some of these convert to inventory.
Now, it's going to take a while for those COVID forbearances to change over to inventory. It's not a switch that happens overnight, probably over a process of several months, you think, or?
I would say most of it's going to be the process over 6 months, unless the people want to negotiate something with the servicer or whoever the lender, and they want to give some type of cash for keys or some type of incentive to move. I think that some of these banks, instead of foreclosure, because I mean, look at all the laws with foreclosure, they're going to do some type of other loss mitigation program that leads to some type of short sale. Is what I see happening.
So
But
how much,
actual foreclosures, go ahead.
if you had to give me a number, how much new supply would you think would be hitting the market nationally from this forbearance expiring?
I don't think enough. I think we need other areas. I think if it's just the foreclosure forbearances alone, again, because it trickles out, Jack. It's not like the great financial crisis. I don't suspect just this alone is going to do much. Maybe it will offset the interest rates, plummeting, Jack. Maybe that will be offset by this inventory. But, it's just another factor to consider. Like, why haven't we seen foreclosures? Well, it's against the law.
So it's a contributor. It's another source of inventory. It's not going to be a deluge that hits all at once, but it is just another sign that there will be more homes on the market in the coming months from
Right.
this.
And I think understanding the role in inventory is important. I mean, I showed your viewers like Dallas, that's an extreme, situation. But when we look at national averages like this right here, this is median sales price for just new homes. This is not existing homes. We've been going down since October of 2022. And in some situations, the sizes of houses got bigger, not smaller. There was this whole shrinkflation rumor going on. So when I actually, looked at the census data, the homes didn't get, well, a couple, okay, let's just say overall they dropped like maybe 40 square foot. Unless you're looking at average from I think Q3 of 2022 to right now has actually got bigger. So in other words, it's because they're overpriced. But anyways, it's really interesting to note that it dropped over $85,000, over 1 year period. And new construction is now down 17.6%. So the thing is, again, the inventory is underreported. Home prices are crashing. They're not counting the seller's concessions. We talked about that. So the reality is they dropped even more than that. There's a complete crisis going on. But a primary reason that is on top of the unaffordability is this right here. It's the supply. I mean, you want to talk about supply and demand and those fundamentals. I mean, you see it. You see it in new homes. Right now, we're sitting at 7.8 months. Historically, we need 6 months. And if you look here, we've had 6 months for, let's just say, since about the beginning of 2022. So we've had, 2 years, Jack, of supply at 6 months. So that's how long it took, without unemployment, without recession. That's how long it took to drop 17.6% in prices. And that's on top of those insane buying incentives. My point is this
pretty interesting, Travis, because this is months of supply, right? So that's total number of houses for sale divided by the number of houses you sell every month. Now, we've seen the months of supply come down over the last year or so, but that's not necessarily because more houses are selling, right? That's just because fewer people are putting their house up for sale. So you've got fewer and fewer transactions happening, but the months of supply isn't really moving because the market continues to slow, but the inventory level is staying pretty much the same. Right? So
I would say that it's, because it's been sideways since about, the beginning of this year. So it started beginning of this year at 8.1. We're at 7.8. So that's not a big movement. But yet everyone is, stocks are all-time high, right? Like, how are the stocks all-time high if the supply, which is a buyer's market, is the same? Now, I'm going to tell you right now, I don't have to put my tinfoil hat to tell you this. It actually says this on the U.S. Census data. Everything is underreported. They can pull off stuff from Realtor.com or MLS or Zillow or wherever they're reporting it, and these numbers are all tainted. I'm telling you right now, Jack, I've been to enough new construction areas where this is probably 12 months of supply. I think it's drastically being underreported right now. And I've proven that, again, in certain subdivisions. We have way more supply than 7.8 months.
Certainly that data around Dallas, way more than the 8 months of supply they're showing there. And that's, forget the STR ban whenever that finally hits also.
Yeah, but nevertheless, I mean, when we look at Redfin, existing home sales have been stubborn. Okay, we haven't had a lot of inventory. That's why I'm saying when we have significant rate cuts, I think there's going to be enough people coming off the sidelines to offset the wreck demand. But I think if they're little tiny baby rate cuts that happen right now, absent unemployment, absent economic turmoil, I think that, mindsets, I don't know how else to say it, they're so weak. I think it actually will put pressure in some areas temporarily on prices going up. I think that's going to happen. Again, the specificity of what I'm saying, Jack, geez Louise, I mean, I'm very specific. When we have the economic turmoil, the game's over. The game is over. Now, take a look at this. This is interesting. This is Redfin data right here. On the right is the loser column, which there's 3 metros. On the left is the winner column, which is more metros. Now, if we look here, we only have 3 metro areas on the year-over-year price decline list from median sales point. Okay, so this is median sales price. Notice something about those 3 metro areas?
All Texas.
Every single one. We have Austin down 5.3%, San Antonio down 3.3%, Houston down 1.7%. These are all areas that I've covered. I've done boots on the ground at each of these, and you know what's crazy? Dallas isn't even in there yet. Dallas isn't in there yet. I don't trust this data because anyway, it's a long story. I could show you other things that would blow your mind. But nevertheless, the number 1 state of new construction, Texas. We have hyper supply in Houston, in San Antonio, and in Austin. And so the data you're looking at is existing. This is not, the data you're looking at right here is not new homes. This is existing homes. So this is why I'm saying, if you're blessed enough to be in a metro area, data is so important. Data is so important. What's happening is it's all over the place right now because things haven't broke. When it breaks, usually every metro is hit in some form. But in these metro areas are screwed. Even if we don't go into recession, even if we don't have unhinged unemployment, unless, again, wage growth explodes, the migration in continues. But right now, as you know, sorry, Austin, the migration is not propping up prices. And look at the left side. Look at the winners. Anaheim, 9.2%. That is the most unaffordable metro that they track. So the most unaffordable metros are seeing the biggest impact on median sales price growth. I think that is a ticking time bomb. And when we really analyze the places on the left, one thing that we know, they don't have new construction inventory. They have almost no inventory. I'm surprised San Diego's not on there. San Diego's off there. So San Diego, no inventory, Anaheim, no inventory, and the new home inventory that they do have, Jack, it's $1 million, 1.2, 1.3 million. So it's almost untouchable. And so you see areas that are super hard to break into from an affordability standpoint, continuing to hold prices firm. And I believe the reason that is limited inventory, and only the top 1, to 5% of America are playing this game. This is not data based on natives. This is not data on the locals purchasing houses. This is data based on, in my opinion, migration and inventory.
Yeah, I can't believe Newark, New Jersey makes the list for biggest year-over-year price increases. All right, the one thing Newark, New Jersey is known for, besides the smell, is car theft. Newark, New Jersey is the car theft and carjacking capital of the United States. So maybe there's mass migration into Newark as all the car thieves congregate around Newark, and that's why the prices are rising. Or maybe this housing market is just completely defunct and separated from the reality of what life on the ground is really like.
And so data, my friend, data is extremely, extremely important. I mean, again, and that's why I stick to my areas a lot. I've been traveling a lot because I got to see it for myself. I mean, it's easy to see when I go outside of my backyard, I go north, east, or west, and I'm in a boom, in potentially in an epicenter of a housing market crash. I mean, literally even in my backyard. So for me, it's just so much easier. And then you top that with I already lost everything. But what I also think is important is the new listing data right here. Now, usual suspects, okay? New listings are up 24%. That's significant in Phoenix. Guess what's in Phoenix? Massive building. New construction building everywhere, especially in Surprise, Gilbert area. I can't remember another subdivision. I went all over Phoenix. Orlando, Florida, 21%. Also, I think there's a lot of new building. Now, Miami is surprising. I think what you're seeing in Miami is you're starting to see the market catch up to itself, starting to realize that, wow, we really ran up prices because there's not, and I know this because I just got back, there's not a whole bunch of new building going on there. So it's surprising to see Miami there, but we got another Texas, Fort Worth, Texas, 13.6. And of course, Nevada, heavy in new construction as well, at an increase of 13.1. I would say overall, man, I mean, it's never been a more important time to use the data. I don't think anyone should be settling on the biggest financial transaction of their life. So again, I think these little tiny baby polarized rate cuts, I think it's just continuation of nonsense. I think it potentially can create a new round of fear of missing out, depending on the metro. I think that could overinflate things much more. But I think all of the fundamentals, when we look at it, I think this sucker is just waiting to collapse. And I honestly have a hard time believing any metro area will escape some type of correction and deflationary event. Even Anaheim, even San Diego. I mean, it's completely out of whack.
So a couple of the takeaways from your data, and thank you for putting all this together for us, by the way. You're not worried about 25 basis points, 75 basis points. It sounds like the bigger question is soft landing or not, because if we do achieve the soft landing, then maybe those 25 to 75 basis points do send prices a little bit higher. But if we don't achieve the soft landing and unemployment spikes, it doesn't matter, because as we've seen with some of the data around some of the cities and metro areas in Texas, the market does not really have the capacity to absorb new inventory right now without seeing a pretty fast decline in prices. So the new inventory is still not really showing. It is showing in markets where there's still room to build. Texas, Phoenix, we saw that. And that's the area where there's a lot of new listings and the prices aren't doing so well. And then you go to some of the older cities and some of the more built out places, or the California cities where it's hard to pretty much build anything, where you're not seeing the new construction. Those prices are still rallying there like crazy, even though those aren't necessarily really great places to live. So interesting dynamics in the housing market. Are any of my takeaways off? Did I miss any real key points in there?
I mean, no, that's pretty much the nail on the head, man. Until we have an event, I think the areas that are tight are just going to get tighter, and the areas that are looser are just going to get looser because of, again, a lack of fundamentals. And the price is shooting up worse than the GFC in 2 years. I think at this point, man, again, if I ask myself, okay, why, I'm bearish. Why was I wrong this year, right? Why did we have such a rebound? Why did I get that wrong? The reverse repo market. I mean, to me, that has been a huge wake-up call. Like, hey, remember, there's still $2.2 trillion as of May 31st of this year. There's still $2.2 trillion of, we'll just say, money printing that's still in the market. So now that I'm seeing that like crash down, we're seeing that, drain right now. I think that's going to be one of the missing pieces of the equation. I think once that money and liquidity runs out, Jack, the smoke screen is not going to be there. It's going to be easier to see what's going on, and honestly, and things are not going to be propped up as much. I cannot believe, though, honestly, that we see places like Anaheim up 19% year over year. I mean, that, and I'll be honest. And again, I asked myself, why was I off? That one hit me, by surprise. But what I'm saying is, what I'm saying is I haven't been proven right yet. To me, it just means the bubble got bigger, and the potential for pretty violent recession and sudden recession is just increasing. The fact that they're saying 20% likelihood of a recession when we're still inverted the way we are is crazy to me. But again, in the tight markets, I think we need an event. I think we're going to, like San Diego, Anaheim, I think an event is going to need to happen, or else it will just deflate slowly, up or down, depending on migration and, depending on things of that nature and supply.
The fact that Anaheim is one of the leading metro markets, in my opinion, just perfectly personifies or indicates how we need a housing crash in this country. Really, for the good of people, we need a housing crash. Anaheim is one of the most upscale neighborhoods in the country. It is the one percenters. And the one percenters are clamoring in Anaheim, bidding up prices because they've got all that inflationary wealth that they have had transferred to them from the middle class through the money printing, through the bidding up of asset prices and the easy money. And now they're in Anaheim bidding up each other's houses to astronomical heights. Meanwhile, all over the same state, you've got middle-class people living in tents or living in cars because they've been priced out of the housing market and their wages haven't risen enough to cover it. We need a housing crash in this country. It's for our own good. It has to happen. And look, I'm a homeowner, and a lot of my wealth is in home equity. I don't hate my own financial interests, but this needs to happen. There's, I just saw an article the other day. Homelessness has risen 12% in the last year, the highest ever recorded. And it's
bad out there.
They could even count that data.
And another thing I didn't even touch on, Jack, is the rental market. I could pull up MLS data right now, and I show you that I have maybe 4 to 5 times more units in the rental market in 6 months. You're probably like, well, how could that be? Well, the apartments aren't just got done being completed. They just dumped 58 listings on my market. Build to rent is now on the market. I mean, the rental market right now, my gosh, I think it's going to be really bad in Houston. I'm pretty sure of that. I mean, the supply of rental houses right now is just, I'm talking SFRs.
And there's a lot of multifamily under construction right now. It's all about
on top of
market.
that.
Yep.
That's right. So we got a lot going on here right now, but not for 1 second do I think that fundamentals don't matter, especially in the housing market. I just think what's happening is just the typical over optimism. And I just think it's really confusing for a lot of people. Even me, this is really confusing. And I think if we really narrow that down, it's the money printing that is still out there. It was the COVID programs that didn't end yet. We see that in the reverse repo market. So the fact that, okay, is the Fed going to pivot? Well, what could it be other than commercial real estate? I mean, I'm willing to put money. I mean, I'm not going to bet anyone, but I think they see that commercial real estate meltdown coming, and then they also see the reverse repo market going down, the M2 money supply going down. A lot of stuff that people aren't paying attention to that are really scary to look at, man.
Yeah, that reverse repo market, I picture that like, you found a giant bag of cash on the side of the road in 2020 and you bought it home. There's millions of dollars in it, right? And your income hasn't changed. Your cost of living went up, but you've been living the high life, spending down that bag of cash, saying, hey, everything's great. I'm rich. The economy's booming. And you don't realize that bag of cash is almost empty. And when it runs out, oh, crap, you can't afford your lifestyle. And that's when reality sets in. That is the reverse repo drain down. And February, that thing gets to zero. I'm not saying everything breaks on February, whatever, when it gets to zero, but something will have to change. Some new program is going to have to be rolled out, or they'll have to start maneuvering differently at the Treasury. They're going to have to do something else in their bag of tricks to kick that can down the road a little bit further come February. So.
And Jack, I mean, overall, I don't think they can do that. So even though I'm saying, the quarter, the 50 basis points, I don't think we can make it to the election, brother. I think that it's going to start falling apart. The cracks are going to start showing. And I think that they will be cutting interest rates. I don't think that they're going to do it significantly, probably until like after or at the end of the first quarter. But I just don't think they can prop it up. I think that they will be shaving interest rates, but I think that it's for all the wrong reasons. The unemployment is going to spike, the meltdown in commercial real estate, potential additional bank failures. I mean, half of the millennials that have recently purchased, again, like I said, they've never been through a period of time where they had to beg for their job. They're used to like people giving them, I don't know. I mean, this is just a sign-on bonus. Are you kidding me? They got some kid that's 19 years old got a sign-on bonus for $5,000. Are you serious? That's not normal, Jack. That's not normal, man. I think it's a very dangerous time to buy real estate overall. There's still investors in some metro areas. I know, in my Discord group, subscribers, they got deals that are good. They cash flow. They have wedge. They're on a 4.5% interest rate. So I don't think there's necessarily going to be this spotlight saying buy this house in the subdivision. I think that's something people need to figure out on their own by, again, getting access to comparable data from the MLS, reviewing what is going on. You really got to do that. I think is going to be, no matter what happens, so important at getting ahead in real estate.
Well, Travis, I want to thank you again for taking the time to talk to us. Great stuff, great data as always. You back it up with numbers and charts. Fantastic job, sir. Folks, that is Real Estate Mindset. I'm going to put a link to his channel down below so you can check that out. Definitely subscribe to his channel. Tell him nobody sent you. I'll give you the last word, brother. Any parting words of wisdom?
Parting words of just, keep, man, don't give up hope. And I really mean that, man. I really can smell it in the air, Jack. People are losing. Oh my God, all my lights are out. People are losing hope, man. So I would just continue to try to encourage people to don't lose hope. And I'm talking real hope, not that fake hope, the displaced hope, like I hope the government's going to bail me out. No, I'm talking about hardworking American hope. You're disciplined now, you're patient now, you get ahead in the future. It's always been that way since I've been alive. And I think that people should stay holding on to those principles. I think they're more important now than ever. And I would just encourage people to continue to do that, continue to love your life, and don't rush things.
Fantastic stuff. And you're right. There's hopium. Oh, no matter what I do and how bad I screw up, the Fed will bail me out. And then there is grit, determination, perseverance, discipline. The latter is where you want to be. Fantastic stuff, Travis. Thanks again. Once again, folks, that's Real Estate Mindset. Check out the link down in the description. Tell them nobody sent you. And until next time, live small and dream big.